Assalamualaikum and hello everyone. So today our group will present a case study report on the option strategies and pricing model in financial engineering. So we are from group 2. So here is my team members: Shamina binti Asri, Muhammad Afiq Aiman bin Sudin, Nur Anisha Aina Batasha binti Ramli, Muhammad Shukri bin Ramli, and me myself Nur Amali binti Zaini. So now let us begin by exploring how investors can use derivatives to manage the risk and enhance the returns. So in case study 1, we analyze the covered call strategy which generate the income while protecting against the moderate downside risk. And in case study 2, we apply the binomial options pricing model to calculate the fair value of a call options under the different market scenario. So together, these studies highlight the practical importance of the financial engineering in guiding the investment decision.
Alright, so now we move to our case study first, number 1. So the question is stated below. Danish is an investor who owns 200 shares of LMN Ltd, which he purchased at 30 ringgit per share. The stock is currently trading at 32 ringgit in the market. Danish believes that over the next month, the stock price will remain stable or increase slightly, but he does not expect a significant price rise. To generate additional income from his existing investment, he decided to implement a covered call option strategy. So option contract details. First type of option, which is called options. Strike price is 35 ringgit. For premium received 1 ringgit 50 cents per share. For contract size 100 shares, and number of contract of sold is 2. So for the question number 1 is identify and briefly explain the option strategy used by Danish. So the answer is Danish used a covered call strategy for his investment. He owns 200 shares of LMN Ltd and will sell 2 call options contract on those shares. The call options have a strike price of 35 ringgit each, and he received a premium of 1 ringgit 50 cents per share for selling them. This gives him immediate income. This strategy works well when Danish expect the stock price to stay around or rise just slightly above 35 ringgit. Since he already owns the shares, the call is covered. If the option is exercised, he can simply hand over the shares he already owns. For question number 2, calculate the total premium income received from selling the call options. So for the answer is, as we know, premium received is 1 ringgit 50 cents per share. So the formula to get total number of share covered is contract size multiple by number of contracts sold. So the calculation will be 100 multiplied by 2, and the answer we will get is 200 shares. Next, for the formula to get total premium income is premium received multiplied by total number of shares covered. So the calculation will be 1 ringgit 50 cents multiplied by 200 shares, and the answer we will get is 300 ringgit. For the question number 3 is determine the break-even price of the strategy. So as we know, purchase price is 30 ringgit per share. For the premium received, we know 1 ringgit 50 cents per share. So for the formula to get break-even price is purchase price minus premium received. So the calculation will be 30 ringgit minus 1 ringgit 50 cents, and the answer we will get is 28 ringgit 50 cents. That's all from me. Thank you.
For the question number 4 and 5, we want to calculate the maximum profit possible for profit and loss. From the profit, maximum possible profit we can get if the share price is higher than the start price. For the max possible loss is when the stock price is higher than the purchase price. For the question number 4, profit per share is 35 plus minus the 30 plus premium 1.5, we will get the maximum profit can we get is 6.5 ringgit. And we multiply the 200 number of share, we will get the maximum profit we can get 1,300 ringgit. That same happen to, not same, for the maximum possible losses is purchase price minus the premium, we will multiply with total share. 30 ringgit, minus with the premium 1.5 ringgit, we will get a 28.5, which is 28.5 is the break even. We minus with 200, we get the possible of the maximum loss is 5,700 ringgit. At a normal transaction, if the price is 25, we will minus 30 minus 25, we will get loss at the 5. But because we make this strategy, they need get the premium call one benefit 1.5 ringgit. So 1.5 ringgit plus with the negative 5, we will get the actual value we lost at 3.5, not the 5. 3.5 minus, we multiply with 200, we get the actual loss is 700 ringgit. Next at 28 ringgit, still the same case, and we get the number of loss is 100 ringgit. At 28.5 ringgit is special because 30 ringgit minus the premium and call 1.5, this is we get the 28.5. So 28.5 and the 28.5 to the 30, this is the range of the risk sponge. So there is no loss at this price level. Next, if the price go even higher to the 30, we get the profit at 3 ringgit, and plus with premium call 1.5 ringgit, we get the actual value is a 4.5. We multiply with 200, we get the 900 ringgit. If the price go to 30 ringgit, we will get the profit with the same way, which is 1,300 ringgit. But if the price go even higher to the 30, go even higher from the 35 ringgit, we will lock the price at the 5 ringgit. You can see 38 ringgit minus the 30, we will get the 8. But we lock the price at 5 ringgit because 5 is the maximum profit we will lock from this strategy. So 5 ringgit plus 1.5 at the premium, we will get 6.5 value of combination. So we multiply with 200, we get the same value as a 38 ringgit with 1,300 ringgit. Now we go to question number 7. From this diagram, we can see the niche make a long stop at 30 ringgit, but they need expect the price is not even go higher or lower, so they make a short call for the covered call strategy. For this strategy, we can see if the price go below the 30 ringgit, the below 30 ringgit at the SC line, there is still a profit because from the covered call, they need put the premium call at 1.5 ringgit, which is if the price not go below the 28.5 ringgit, there is still profit from the daily. But this is the benefit of this sponge is go lower, go negative if the price is lower from the 28.5. But if the price go higher than 30, can get the premium call at the 5 ringgit, but the SC line, above the 30 is flat because we lock the price at the 30 ringgit. But for if we see the overall overall line, this still increase because from the overall line, we include the cupcaps. We add the cupcap outside with a premium coil. So the maximum benefit we can get from the overall is a cupcap outside plus with premium coil. Right from the SC9, you can see we fed until the 35 ringgit. Because 35 ringgit is the straight price. We lock the price at 35. If the price if go higher than 35, they need to get the benefit of that higher. Because we already locked the price at 35 ringgit. If the price go higher than the 35, the investor will purchase the ticket. So they need should to buy the ticket at the lower price, which is 35 ringgit, even the price is higher than 35 ringgit. That is what we can conclude from this diagram. So the maximum profit we can get here is 6.5 ringgit, and 1.5 is the sponge for the long stop.
Based on this strategy, this strategy is suitable for the niche because with the sideway or expected that price not go or so higher significant. So this is good because the niche can get additional income and protect their price from the falling at the premium 1.5 ringgit.
So now let us move to case study 2. So in this case study 2, we focus on the binomial option pricing model. In this case, we are given a call option with a strike price of Rm30 ringgit and a current stop price of Rm35 ringgit 50 cent and a 3-month expiration period. And this stock assumed to move with a monthly volatility of plus or minus 10%, with an upward probability of 70% and a risk-free interest rate of 2% per month. So using the binomial framework, we calculate the option value step by step, showing how probability and volatility affect the payoff. And this case illustrates the importance of quantitative modeling in determining the fair option price.
Next, I want to walk you through the mechanic of a 3-step binomial option pricing model. At its core, this model is a map of the future. We are starting today with a stock period at 35 ringgit and 50 cents. In the world of finance, we know the price won't stay there, but we don't know exactly where it will go. To manage that uncertainty, we simplify the world into two possibilities, which is the stock goes up or it goes down. Looking at our first step, we have set an up factor of 1.1 representing a 10% gain and a down factor of 0.9, a 10% loss. We have also assigned a 70% probability to the upside and 30% to the downside. This gives us our first two nodes, which is 39 ringgit 0.05 cents or 31 ringgit 95 cents. As we move into the second and third steps, the tree begins to branch out significantly, but notice something interesting. This is what we call a recombining tree. If the stock goes up then down, it ends up at 35 ringgit and 50 cents. If it goes down then up, it ends up by the exact same spot. This is mathematically elegant because it prevents our model from becoming a chaotic mess of too many numbers. It simplifies the possible outcomes into 4 final price points at the third interval. At the top of spectrum, we have the best case scenario at 47 ringgit 26 cents, which require 3 consecutive up move. At the bottom, we have the worst case at 25 ringgit and 38 cents, representing 3 consecutive drops. Now, let's look at the right side of the slide under the pathway. This is the secret sauce of the binomial model. while there is only way to reach the extreme high up, 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 or the extreme low down, 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 there are actually three different ways to end up in those middle price bracket. For example, to reach 38 ringgit and 67 cents, the stock could go up, up, down, or up, down, up, or even down, up, up. Why does this matter? Because when we calculate the final value of an option, we have to account for the fact that these middle outcomes are statistically much more likely to happen than the extremes. Now, let's look at the right side of the slide under the pathway. This is the secret sauce of the binomial model. In this scenario, we are looking at a call option. A call option gives the holder the right to buy a stock at a fixed price, known as the strike price, X. In our case study, the strike price is 30 ringgit and the formula for the payoff at the end of the period is payoff equals to maximum of S minus X. Here is the breakdown of those four pathways. The first one is the base case, which is UUU. The final stock price, 47 ringgit, 0.26 cents. The calculation is 47.26 minus 30 ringgit, which is the result is 70 ringgit and 26 cents. So, the result, since the market price 47.26 ringgit, is much higher than our strike price, which is 30 ringgit, the option is in the money because our payoff is 70 ringgit and 26 cents. Second, which is the moderate case, UUD, UDU, and DUU, which is the final stock is 38 ringgit and 76 cents. The calculation is 38.67 minus 30 ringgit, and the answer is 8.67 ringgit, which is the result. The stock still perform well and we can buy for 30 ringgit and it's worth 38.67 and leaving us with a payoff of 8 ringgit and 67 cents. The third one is the low profit case, which is UDD, DUD, and DDU. With final stock price 31 ringgit and 64 cents. The calculation is 31 ringgit 64 minus 30. The answer is 1 ringgit and 64 cents. And it's with the stock barely stay above the strike price, and we still have a small positive payoff, which is 1 ringgit and 64 cents. And the last one, the fourth method, is the out of the money case, which is DDD. Final stock price is 25 ringgit and 38 cents. The calculation is same, 25 ringgit and 38 cents minus 30 ringgit, which is we have negative 4.62. The result is this is the most important part of our option theory. We would never exercise our right to buy a stock for 30 ringgit if we could buy it on the open market for 25 ringgit and 38 cents. Therefore, we let the option expire and the payoff as shown in the image at negative 4.62 is ignored and corrected to 0.
So next we will move on to the how to determine the position of the payoff trade. First thing first is about in the money. In the money means an option that would make a profit if exercised immediately, which is in this situation call option, which is strike price must below the market price. And next is about out of the money, which is OTM, an option with no intrinsic value, meaning it has only time value and would result in a loss if exercised now, which is in this for the call option, strike price is above the market price, and for the put option is strike price is below the market price. So when we calculate the binomial option pricing, the payoff trade that we got is first is 47.26 minus 30 is equal to the positive 17.26, which means the position of this is in the money. Next is 38.67 minus 30
equal to 8 ringgit and 67 cents. This will be in position in the money too. And next is 31 ringgit and 64 cents minus 30, which equal to 1 ringgit and 64 cents, also in the money position. And last but not least is 25 ringgit and 38 cents minus by 30, which equal to negative 4 ringgit and 62 cents. And this means this is equal to 0 because this position is out of the money position. Okay, after we know the payoff trade, next we will move to how to calculate the current value. So the current value for this question is equal to 17 ringgit and 26 cents multiplied by 0.7, 0.7 and 0.7 three times because we choose up plus with 8 ringgit and 66 cents multiplied by up down, which is 0.7 multiplied by 0.7 and multiplied by 0.3. Last is multiplied by 3, which is 3 months, plus 1 ringgit and 64 cents. We choose up down, so the calculation will be 0.7 multiplied by 0.3 and multiplied by 0.3 and then multiplied by 3 months. So overall of this will be divided by 1 plus 0.02, which is risk-free rate, multiplied by 12, which is months, and per, and divided by 3, and then lastly is concluded all and the power of 3. So the final answer will be 7 ringgit and 98 cents.
To conclude, our analysis show that option strategy and pricing model are powerful tools for an investor, and the covered call strategy offers stability and income, while the binomial option pricing model provides a structured way to value options under the uncertainty, and both approaches demonstrate how financial engineering helps balance the risk and return in the real-world markets. By applying this method, investors can make more informed and strategic decisions. That's all from us. Thank you.